Hello, everyone, and thank you for taking the time out of your busy schedule to join us today. We are very, very happy to have with us Jason Graham, who is with Columbus Life, to talk about survivorship IUL. Once again, if you have any questions, we have quite a few people on the session, digital session today. If you have any questions, you can drop them in your chat box. Or you can hold them to the end of the session, and we'll be more than happy to answer those questions for you. Again, thank you very much for the time that you've taken out of your busy schedule to join us. Hopefully, our goal is for you to come away with 1 or 2 ideas that you can implement in your practice, hopefully immediately. With that said, welcome, Jason. Thank you for taking the time out of your day to do this. And hopefully you have access to everything. Take it away.
Hey, thanks, Louis. I really appreciate coming on with you guys again. It's been hello, everybody who haven't know me. Again, my name is Jason Graham. I'm located in Orlando, Florida. Just a hip skip and a I can't even try to talk today. I'm right near Walt Disney World, so but I don't go to Disney quite a bit. But but my kids do enjoy it, and they go there from time to time. But really appreciate you guys taking your time to talk a little bit about survivorship, IUL, and Columbus Life, and so forth. And I know you may be saying to yourself, survivorship. Those that have been in the industry long enough are scratching your heads trying to figure out survivorship. I thought survivorship was dead, second to die. What are we talking about here? With the estate tax being the way it is right now, where the limits are and so forth, usually survivorships have always been used in those types of sales. Well, I can tell you that traditional way of thinking has gone the way of the dodo. And we see a lot of planning applications that can be done from survivorship. So I hope with these 2 or 3 concepts I'm going to talk to you a little bit about, that this will give you an idea of where you can really broaden your knowledge base about not only Columbus Life, what we have to offer in terms of as a competitive product, but ideas that you can take out there immediately into the marketplace and really talk to a lot of your clients about that. So first things first, I'm going to share my screen here. I don't have like a normal PowerPoint presentation. I'm actually just going to work off flyers and illustrations for you guys, just so that you can get an idea of, and these are pieces that I can definitely send over along to you all after the meeting, and Louis can have these, and then we can, you can take a look at these and go from there. So let's talk about IUL in general. Obviously, IUL has been a very popular product, throughout the industry, over the last 5 or 10 years. You're mainly seeing more accumulation sales and more death benefit sales, even though you're starting to see more carriers kind of get into the protections-oriented type IUL business. But the majority of cases that are done nowadays is on the accumulation side. And obviously there's some appeal to that because of the tax treatment of life insurance under our IRS code, but also the ability to participate in having market-like returns without the market risk. So, fast forward now, and you're going to start to see, particularly in the survivorship space, there's not many players that play in that space. There's some reasons for that. Some carriers, again, still think of the idea that a second to die policy is really for estate planning, and they feel as though that those cases would not warrant an opportunity, where it makes sense from a financial standpoint to offer a product like that. But at Columbus Life, we obviously are, looking outside of the in the box in terms of how traditional estate planning is done. And we can really see how survivorship IUL can play a very intricate role in terms of your traditional death benefit sales, but also from an accumulation standpoint. So if a lot of you know that, the concept of life insurance, retirement plan, or LIRPs, those are mainly used, for index universal life, anything that's an accumulation type product. So this could be used for VUL, could be used for whole life, could be for IUL. But majority of sales that you see are going to be more so on the IUL side. Well, those sales are great, and there's a lot of benefit and so forth in terms of that. But there's always going to be this underlying issue that's going to come up with regards to using IUL with regards to life insurance retirement plans, is the timing at which that you get in front of a prospect to talk about this. And what I mean by that is talking to somebody that's in their 30s and 40s is a little bit different than talking to somebody that's in their 50s and their 60s. And they like the idea, they like the concept of this life insurance retirement plan. But as you know, with these types of products, they're not short-term investments, they're long-term investments. And when you start talking to people that are in their 50s or 60s, the one thing that you have working against you is the time value of money, meaning they don't have enough time to be able to build up the cash value and that they need to potentially draw income from the policy down the road. So that is always going to be an issue when you're talking to these clients about these types of plans. So what we've done is we've talked about, well, we can't get away from the whole time value of money conversation because it's going to be there regardless if there's somebody's in their 50s and 60s. But what we can do is we can use a product that can help us in terms of reducing the cost of the overall contract that can fight against the time value money conversation. And that's where our survivorship IUL product comes into play with that. Survivorship in itself is, the main differences between an individual and a second to die is that death benefit is not paid out at first death, it's paid out at second death. Okay, so you actually have a much longer time, you have a longer time period for which a death benefit is going to be paid out versus an individual policy. Well, what does that mean to you? What does that mean to the insurance company? Well, the insurance company has more time to put that money to work to generate a good rate of return on their portfolio. So in those situations, they're not going to charge as much in terms of cost of insurance in these contracts as they do versus an individual contract. So even though that we still have to deal with the time value of money conversation, with a survivorship product, you can actually get a product that is actually the lower cost than an individual policy. So this little flyer is going to kind of give you an idea of an example of what I'm talking about. So you're going to see over here that we're looking at an illustration for our individual IUL product, which is our Index Explorer Plus product. So we did a scenario where we had a 55-year-old male that was putting $20,000 a year into our individual contract for 15 years. And then we also did the same for a female 50, standard non-smoker. And you can see on the male, they put 300 in and they have initial death benefit of 355. And the cash income coming out of it starting at age 66 is going to be just under $38,000 a year coming out. But you can also see if you did it on the females, if you did that on the female as opposed to the male, you're going to see that you're going to get more death benefit, but also more income coming out of the contract, because as everybody knows that women tend to live longer. So cost-wise and death benefit-wise, the carriers are willing to give insurance out at a lower cost and allow a lot more coverage to the female. So looking at those two scenarios, I mean, in those instances, I mean, the income looks pretty decent. It's pretty good. You know, 38,000 over 20 years, that's $760,000. That's nothing to run, cry home to mom about. Same with the female, just under 41, just over 41,000 over 20 years. That's over $800,000 in tax-free income. Well, what if we did a survivorship case where we put that same male and female as joint insureds on this contract, fund the same premium amount? Let's see what happens with that. And you're seeing that we're putting the same premium. We actually get a much higher death benefit because it is a survivorship and there's a longer expectancy in which that death benefit's going to get paid out. But look at the income generated. Just over $48,000 in income is being generated out of this contract. And as you can see, versus just doing a policy on the male, that's an over a 22%, almost 22% more income out of the contract than in the individual contract, with the female is just under 15%. So you can see in these instances where the survivorship can play a very good role in the whole life insurance retirement plan from an accumulation standpoint, because it allows us to combat against the whole time value of money by giving us a product that's going to give us some lower cost. Now, I don't have a flyer about this, but let's take it another step further with this particular concept with the life insurance retirement plan, the LIRPs. So let's say you meet with somebody that's in their 30s and their 40s, and they really like this idea as part of their retirement plan. But what would be the one thing that could change the dynamics of the policy if you were doing an individual policy? What if that individual is in really bad health or is uninsurable? Well, if they're in really bad health or uninsurable, pretty much kills your sale in terms of this concept and this idea. Why don't you use a survivorship policy? Because our survivorship product, and most carriers are out there the same as well too, we will allow one uninsurable on the contract, and the other individual uninsured can't be worse than a table H with us. So you have a lot more flexibility to be able to do a plan like this for somebody that may be younger, but may not necessarily be in the best of health, and be able to leverage the survivorship policy as a way to combat their underwriting. In terms of, because if they're highly rated on an individual policy, it's going to cost them way more down the road on that contract than it's going to be on the survivorship, where one is highly rated and the other one could be a standard or preferred risk. So this is our product is a really good way to talk to those people that are getting closer to retirement, and you're trying to combat the whole time value of money conversation to do a plan like this, or dealing with individuals that are younger, that are right there, that have the time value of money on their side, but they may not necessarily be in the best of health. So again, I think for those situations, you may just want to, take a look at us from there. And if you have any other questions about that, we can definitely, we can touch on that. But again, this is a piece that we use. I'll pass it along to Lewis to be able to take for you to have and use this as a way for you to understand the concept a little bit. So with that said, this next concept to talk about, and a lot of this has to go with the ideas that I know that we've raised, rates have been, I think there's a chat question here. All right, the question, Roberto, good question. Can you confirm that the insurable spouse can be as low as a table H? Yes, that is confirmed. It's actually in our product guide. I can send that along to you, but yes, if one of the insureds is uninsurable, the worst that the other insured can be is a table H with us and still be able to have this policy. So any other questions before we move on to this next concept using our survivorship product? Okay, so this next concept is really about talking with clients that have idle money sitting on the sideline, where it's in a CD or money market, or earning pretty much next to nothing. I know rates have raised up a little bit because the Fed's raised rates last month, and there's an expectation of those rates will probably continue to get raised a little bit, which is going to help in that instance. But you're still dealing with a couple of other factors into that. One is if that money is earmarked for something that they don't need, or they're using this as more of a kind of a legacy plan perspective, leaving it into a money market or a CD, you're paying taxes on those interest earned every year. Plus, and obviously everybody's seeing the inflation numbers coming out right now is that that same dollar amount is not going to buy the same amount of goods in a year's time. And so there's no way to really combat the inflation aspect of this because, you know, that money is still earning a relatively low rate of return in relation to what inflation is. So where you can use survivorship in a particular situation. Now, in the some of these other instances, you know, you may gravitate to the annuity side, using an annuity, because obviously that money is growing tax deferred, and as long as you don't take any money out, there's no taxes being earned. But when it comes to death, obviously that money then becomes a situation where it could potentially be a taxable event, depending upon you know, what your client's particular tax situation may be. But a lot of times people go to the annuity side because it's the path of least resistance. There's no underwriting. You just got to, you know, meet the financial suitability of that you know, of that particular company and that product. Where I think you could use survivorship in a way, one, that combats the whole underwriting. Because remember, we could take at least one uninsurable and the other can be no worse than a table H, but we can really enhance the money that they're using for legacy down the road to create a much bigger pool of dollars that are going to be available to their heirs on a tax-free basis, because you don't get that on the annuity side. That money is not going to be, when it gets passed down to the beneficiaries, is going to be passed on an income tax favorable basis. Yes, VG, I will touch on that in terms of cash value and surrender charges. We will definitely touch on that. And I'll show you actually on an illustration how that looks so you can get an idea of that. Plus, we also have a particular rider, like I said, we'll go into that, where you can remove the surrender charges on the contract as well. So by using a survivorship, you're really, you know, creating a bigger pool of money that's going to be passed on more tax efficiently than you would rather than into a CD, a money market, a savings account, or even a fixed or indexed annuity. So you're going to see on this particular piece, using a reference of our individual IUL product in relation to our seconded I product. And you'll see we're looking at two 65-year-olds, a male and a female, has $100,000 that they would like to leave behind and create the best legacy planning situation that's going to benefit their loved ones. So if we did an individual policy, let's say on the male, that $100,000 buys $262,000 in death benefit. That's income tax free. On the 65-year-old female, you're going to see that same $100,000 would buy $317,000 in death benefit, and it will in turn create, you know, some cash buildup. We also have a living benefit rider that's available on that as well too. So again, you could go down these roads, okay? But if you're really trying to maximize what can be passed on, you should really consider using a survivorship product. So we use that same 65-year-old male and female, that same $100,000 single pay premium, and look what happened with the death benefit. That death benefit jumped up to over $450,000 income tax free. And you can see that the cash value buildup and the cash value buildup, as well as access to the living benefit rider, those dollar amounts went up. And again, it goes back to the cost of the contract on there, and the being able to leverage a female insured and a male insured. And you can see that this creates a great way to set aside some dollars in the most tax efficient way possible. Now, I'm going to say this right now. On survivorship products, as you know, the death benefit doesn't get paid out until the surviving insured passes away. So if there's an intent that this money needs to get paid out at first death, this is not going to be the product for you. You may stick to an individual policy like our IUL or any other contract. But if there's not a need to be paid out at first death, and they want this money to kind of grow and build up in the most efficient way possible, this is where you're going to use our survivorship product in that instance. As I mentioned before, we do have a living benefit rider on here. The only caveat to it on our survivorship, it's only available on the surviving spouse. So if you have a male, female that are the insureds on the contract, male passes away, the wife, the surviving insured, has the accessibility to be able to accelerate the death benefit for specified medical conditions, chronic illness, and terminal illness. But even when the husband is still around, they still have access to the cash value. So if there's ever a need that they needed to tap into it to cover for medical costs and so forth, they still have that ability to do that. But just saying, if you're wanting to use the rider instead, it's only available on the surviving spouse. So again, think of survivorship not only as just an accumulation conversation, but also as a very simple legacy planning strategy that can be used for your clients and for the right type of client that that is wanting something quick, something easy, something where they don't have to formulate trust and create all these things to pass things along. Because again, the estate tax limits are so high right now. We're dealing with a lot of clients in this country that don't have an estate tax problem. So I think this is a great opportunity to do some really good legacy planning using life insurance without spending the dollars on trust or any sort of estate planning documents, because a lot of our clients are not going to have an estate tax problem. And if they're on the mind of trying to leave a legacy behind, whether it's to their loved ones or to a charity, this is a great way of doing that. Any other questions regarding this? Okay. I've got one last concept, and it's kind of tied to the whole legacy planning concept, but I call this your concentrated stock/mutual fund strategy. And I'm going to talk a little bit about something obviously you've probably heard on the news that was probably today, was Twitter. Obviously, Elon Musk is making a bid to buy Twitter at $54 a share and make it a private company. And this may not necessarily be Twitter, it could be anybody else, but I'm gonna use Twitter in this example, especially a lot of these tech companies where you might have some clients or any client that might have bought into a company that, oh, excuse me one second. Are there any critical and chronic illness benefits on this policy? VJ, to your question, yes, there is. We have, it's called our Life Plus rider, and we don't do any additional underwriting on the contract. There's no cost on the contract to have the rider on there. And again, on the survivorship, the accessibility of the rider does not kick in until the surviving spouse, for only the surviving spouse. And I have a flyer that actually goes through how we calculate what can be passed out to the individual at certain ages and so forth. So Roberto, same-sex couples okay with this product? Yes. So if there is obviously a insurable interest in regards to that, we will not have you'll be able to do this for same-sex couples. Any other questions? Good questions, first off. So going back to this, you've probably got some clients out there that have talked about maybe they bought like a particular mutual fund or a particular stock that they've held on for many, many years. And a lot of times they're just holding on to it for the sake of holding on to it. Maybe they want to pass along to, Stacy asked this question, does it have to be a single premium or can you contribute monthly also? Stacy, the answer to your question is yes. I don't want you to think that the single pay is the way to go. It obviously does get the money in there the quickest. It does become a mech on there, but it allows you to put that money in there quickly and to work. The mech doesn't have any impact in terms of the taxation on the death benefit, but just on the pulling out of money. So if you wanted to do something where you're contributing to it on a monthly basis, you can absolutely do that. And that would obviously avoid the policy becoming a mech on there, which means if there is a need to pull monies out away from the cash value, you would not have to pay any taxes on those dollars. Good question. So going back to this idea that we may have some clients out there that are holding on to some stocks, mutual funds that have what I call low basis, meaning they bought it, some time ago, that they've been holding on to this. Maybe they're getting a little bit of a dividend. Maybe they're just holding it for nostalgia. As you are noticing, is that the markets are at their all-time high. We've started to see some pullback in the marketplace. Inflation has obviously had an impact on that, as well as interest rates. And as you can see, this is kind of like the history of Twitter. And, it's only hit up around, close to $70 back in 2014. And then again, at some point last year. But if somebody were to bought it in 2014 to now, it's pretty flat. Somebody that may have bought it right here, for instance, has had a pretty substantial amount of gains into this contract. And what I'm suggesting is, now that there's a potential that this company may go private because of Elon, making an offer on there, is that this stock may no longer be available to participate in terms of how it performs, because it's going to be a private company because Elon's going to own all the stock. So what can we do that maybe we can take some money off the table here that is still giving us that appreciation that we want, lock in our gains, pay the minimum tax that we can, and use this money as a way to put it to work in a more efficient way to do that. And that's when we bring in the idea of the whole doing a single pay life insurance policy with this. So I'm going to give you an example of this, and this is just an illustration that I ran. Male, female, age 65, standard non-smoker, ran it at a 6% rate on here. That if they were to sell and net out $100,000 of proceeds from the sale of the Twitter stock, it would buy $350,000 in death benefit, which is going to be income tax free. And as you can see, the cash value, you have up to, 87% of your cash that you originally put into the contract here. And then you're about breaking even around year 4, year 5. And then you can see that it grows and grows at a 6% clip. But what's interesting here is at age 85, 20 years down the road, that 100,000, in order at a 25% tax rate, to get that to that same death benefit, that 100,000 has to do on a tax-free basis 6.46% per year, every year compounded, which comes out to a taxable rate of return of 8.6%. Now, obviously, a stock can do that, but if you don't have Twitter anymore, guess what? You don't have that appreciation aspect of it. But let alone you have the gyrations that the market does. You could be up 20% one year and down 15% the next year. So we're talking about the same concept in terms of legacy planning, but let's turn it on its head a little bit and get down into the numbers a little bit. So I want you to take a look at this. We're taking this female, male, 65, considering them standard non-smokers. So for them to net out $100,000 in death and proceeds to fund this policy, they have to factor in capital gains taxes. They would have to sell $125,000 worth of Twitter stock. And based on, and obviously the price of Twitter is going up and down as we speak, but at close of business yesterday, the cost per share of Twitter was just under $46. So to get to that 125,000, they would have to sell over 2,700 shares of Twitter to be able to do that. So you factor it in, there's the 100,000 that we got after the sale and proceeds. Now we bought that $350,000 death benefit. So now we need to look at this and say, okay, now I just replaced $125,000 of Twitter stock to $350,000 death benefit. What is that equal to in terms of a price per share? So what I did is I took that 350,000 divided by the number of shares that I sold to get to the money to put into this contract. And that got me a life insurance equivalent price of over $128 a share. Okay, let's go back to this Twitter stock page. This is for the life of the stock. When has Twitter, let alone hit $100 a share, $120 a share? Never. It never has. So what you've done is you've decided to take some money off the table from Twitter, cash in, pay the capital gains tax, which are low right now, and redirected that into a single pay policy with our survivorship product that it basically locked in your price per share at $128 a share. And that number is not going to go down. That death benefit is going to stay the same. It can only go up based on the performance of the policy. So you see that in this particular contract, in this deal. So it's growing, cash value 350. Then you start to see it's getting close to the corridor and that death benefit is going up. So that 350 is going to be pretty much, I can't say guaranteed because obviously it's based on what the policy does in terms of the 6% rate, but it's got some movement or some stability that you're locking in at a price per share far greater than what Twitter has ever done in the history of the stock being publicly traded. So what I also did too was going back to the insurability aspect of it. Well, let's say if you have one of those individuals uninsurable. So we're going to go, oops, can't get to that one. So let's go and look at somebody, let's say the husband is uninsurable. So our death benefit goes down from 350 to 305. At 20 years, our tax-free interest rate that they have to earn per year from that 100,000 is just under 6% per year compounded each year. Okay. If you look at the numbers, basically did the same thing here, except we have a lower death benefit. Their price per share on a life insurance equivalent basis is just under $112 a share. Again, Twitter has never hit 90, let alone 100, 110. So this money allows you to at least lock in on a higher per share basis than you would if you just let that money sit and trade like it is with Twitter. And let the market determine what the price per share would be. Obviously, Elon's made an attempt to buy it at $54 a share, but we basically just showed that we can double, maybe almost triple that price per share without any market involvement in leveraging what a survivorship life insurance policy can do. I know that was a lot. Hopefully you can understand the concept. It's basically the single pay concept, but instead of taking funds from a savings account, a CD, a money market, you're taking it out of a stock mutual fund position where you're paying long-term capital gains tax on there and leveraging those dollars into a survivorship policy to be able to do that. I'll be glad to send this all out to you as well if you need some other guidance with that. Looks like we got a couple of questions here. So for Vijay Kumar, did this plan offer option A and B? Yes. So in this illustration scenario, I ran it at option A. You could do it at option B. Could change it. That was going to change the numbers a little bit, but you have that ability to do that. So yes, you can run it that way. Roberto asked, what is the maximum issue age for one of the insureds? It's age 79. Is the oldest that we can go in terms of the insured on these contracts. Vijay Kumar asked, is the rate is guaranteed? So there is not a guaranteed interest rate on this product, but we do have a fixed account option in here. So if you're not really comfortable with putting all or some of the money into the index account options that we have, there is a fixed account option in there that's currently paying 4.2%. I believe the lowest that it can go down to is 3 on there. But in terms of the index accounts, they have the worst case scenario is going to be a 0% floor on there. But that's really as far as we go in terms of a guaranteed rate. Speaking of rates, I want to give you an idea of where we are in terms of our cap rates and our illustration rates. So with our survivorship product, we do have a 0% floor option, and then we have a 1% floor option. honestly, the 1% floor doesn't really appeal to me because you're giving up a lot, particularly on the annual point-to-point cap. You can see it's a big difference in terms of cap from that perspective. And you can kind of somewhat synthetically create a better floor rate by using the fixed rate, the fixed interest account in the product. So not necessarily putting all the money into the index. You could put monies in a portion of it into the fixed account to where you can get that so-called floor to offset, you know, if the market doesn't perform well enough to do that. What you're going to notice with our survivorship product is that our survivorship product, whatever our caps and participation rates are going to be identical to our individual products. So we're not doing anything that we're going to say one product is better than the other. But also on the other side of that, once you put an in-force piece of business with us on our index products, though, anytime we make a rate change or a participation rate change, we change, it's the same as if our new business. So if our existing policies, those that are in our annual cap point-to-point S&P 500 that has a cap of 9.5%, also our in-force block of business has an annual cap of 9.5%. Where you start to see some carriers, and I can't remember, Symetra, for an example, they recently just made some adjustments on their cap rates, and you notice that their in-force business cap rates got reduced more than their new business cap rates, and we don't do that. We feel like, you know, our policyholders are our shareholders, and we're going to treat them as if they're clients that are bringing in new business to us. So, so hopefully this gave you some ideas on why you can use Survivorship IUL outside of the traditional means. It's a great tool for accumulation. It's a great tool for retirement income down the road, but it's also great for very simple and very, you know, a good way of leveraging from a legacy perspective. So that is all that I had today with this. Hopefully you didn't feel like I fed you through a fire hose. I will continue to take any questions you may have that in regards to this. And Lewis, I'll just pass it back to you.
Thank you very much, Jason. Appreciate it. A lot to take in this afternoon. Does anyone have any other questions? I think you can unmute yourself if you want to join it in the conversation, and/or jot it down in the chat box. I'll open that up for questions. Anyone? Great. Awesome. So a couple of key takeaways that I took away from this. The usage of an SIUL as an alert product is a very interesting concept. The fact that you can have one insured up to table H, maybe we can use that in some of our practices. The living benefits, the Life Plus rider that you can attach to the products. And then also the concept of leveraging maybe underperforming assets and or risky assets and repositioning them into an SIUL product seems very, very interesting. And I think it could go into some instances. With that said, since there are no questions, once again, I want to thank everyone for their time today, for joining us. Please, if you have any questions, concerns, please do not hesitate to reach out to Phil, Mr. Phil. Did you see that question there, Jason?
Yes, I did. Phil, yes. So not only our individual product, but also the seconded I product that we've been talking about are available for premium financing. We have guidelines in terms of that, and I definitely can pass it along to Lewis. Actually, Lewis I'll send it to you again, Lewis. It's not a problem. In terms of what our guidelines are for premium financing, we do also have approved lenders that you can use from that regard. So yes, we do allow premium financing. And I forgot, I apologize. I know VJ asked about we do have a early cash value rider that basically removes the surrender charges on the contract. What's nice about that is that we do pay out full comp on that. Whereas most carriers, they actually levelize the compensation out over a number of years. Whereas we would pay it out as if you didn't have the rider. Now, the only big thing is there is a 5-year chargeback. That chargeback is on a sliding scale from, it starts at 100% down to 80, the 60, the 40, the 20, and that's only for 5 years. But if you've got a client that's really adamant about showing, high early cash value, then that's something to consider. Now, it does impact the performance of the policy because it is a rider, but that is something that you as an agent and the client can determine if that's going to be appropriate for whatever their particular situation is. Only on surrender, Phil. Good question. Yeah, so we wouldn't charge a chargeback on if it was at death. It would only be at surrender.
Cool, thanks.
No problem. VJ, can the age of one spouse be over 79? I have to check on that, but I want to say that the oldest cannot be older than 79. But let me double check on that.
Perfect. One other thing I thought of when you're looking at the IUL products, whether it's an individual or an SIUL, Columbus Life products are very easy. They don't come with that many bells and whistles and all the extras that some of the other products are out there. So I guess Jason might be saying this correctly, the fees, the internal fees and the cost of insurance are less, which is advantageous to your client later on as the policy begins to accrue cash accumulation.
That is
so
correct.
I did wanted to bring that out because it's a very important when you're looking at something and someone's showing 12% or 11% and we're showing 9.5%. You have to look at the cash values later on and quite possibly even the distributions later on. So that's very important.
I think the other thing too to hit on, Lewis, is that some of these carriers have these bonuses. A lot of them are non-guarantee and you're paying for those bonuses. So, you want to be mindful of that to see what the cost is, because again, if they don't hit the points in terms of getting that bonus, that client is still getting charged for that bonus regardless. So we don't play that game. And to your point is we're very transparent. What you see is what you get. You're not going to see anything that is going to be like, how is that done? Because we ultimately feel like you as the agent are responsible for understanding how these products works for your clients. And if you don't understand how that product works, your client is not going to understand because you're not going to be able to articulate that. So we are mindful that we try to keep these policies as simple as possible to make it easier for you to talk about so that you can talk about this to your client. Jamie, non-med issued IUL. So we do have an accelerated underwriting program. And we go up to age 55, up to $1 million in coverage. And you could potentially get our best rate class on the contract. And that basically, you have to do an e-app with us now I believe the survivorship's not eligible for that because we don't have it on e-app yet, but our individual IUL product, it is eligible for that. And as long as you do an e-app, we do all the database search and so forth, make sure that everything looks okay from from that perspective. We can potentially make an offer without the client being poked and prod and getting examined. So yeah, we do have that. You're welcome. Thank you.
You're welcome. You're welcome. Thanks for joining. Once again, everyone, thank you for joining. I'm truly grateful that you've joined us today. And hopefully you've gained something to think about and maybe you can add to your practice. If you're not, I see some new guys on this webinar and some older ones, the older guys. As always, thank you for Thank you, Arlene. Thank you for joining us and for your continued support and Business of Best Agency. Those of you who are new, please reach out to either myself or to your internal marketer here. We'd love the opportunity to earn your business. And whatever it is that we can do, we definitely will try to do it. I will say, just as a best agency plug, we're pretty damn good at what we do, and we've developed very good relationships with Columbus Life, as well as some of the other carriers that we work with. And we will love the opportunity to earn your business. So with that said, Jason, thank you very much for the time today. A ton of great information. Thank you.
You're welcome.
And look forward to seeing you in person soon. Everyone
Likewise.
else, thank you very much. We look forward to working with you. Thank you.
Thank you, everybody.